Alright, welcome back to the channel. In this video, I'm gonna talk about the 5 investing strategies to make you rich fast or faster. Traditionally, you have ways of investing and saving, but then there's additional strategies that accelerate that path so you can do it in a shorter amount of time. So in this video, we're gonna cover the 5 strategies in order for you to do that. Stick around to the end and I'm gonna share the exact assets that you can also consider and action items for you to do starting today in order for you to start investing smarter and more strategically. So if you're ready, let's go. First off, before we jump in here, if you've ever considered getting more customized information or any advice regarding side hustles, regarding investment, or any questions about retiring earlier and faster, feel free to drop a comment and then subscribe to the channel. Every month, we're gonna be choosing one winner for a free consultation where we would talk to that winner and then give them advice on how to best continue with whatever they want to achieve. So if you want to participate, make sure to like the video, subscribe, drop a comment, and then every month we'll be picking one winner and we'll be giving away that free consultation. Okay, so let's get started. Number 1, the first strategy you want to consider is taking a look at high growth stocks. This is, you have your traditional investing where you would put in your funds in the S&P 500 or the TSX, where you have an expectation of a 7 to 9%, on average 8% return every year. Now with this strategy, what you want to do is you want to take a look at industries that have a bigger upside potential, right? So what do I mean by this? Let's break it down into an example format here. On a global setting, you have companies like Nvidia and Tesla. And if we take a look at Nvidia, for example, this is the chart for Nvidia. And let's go back 5 years. Now, if you heard of or started investing in Nvidia 5 years ago, you would have picked up a big ROI, right? Because the price range from $15, $13 to now $133. So that would have been a 10x return if you would have come in with Nvidia at the right time, right? So now with all the craze with AI and then chips and superconductors and all these things, Nvidia still has the potential to go up, right? But you want to take a look at how it's performed over time and assess your decisions on what other industries could be affected with the growth of Nvidia, the semiconductor or the chip space in general, right? So that might be affecting the healthcare industry, that might be affecting other industries that might also benefit from the rise of AI and then Nvidia. So you can start taking a look at related industries that are also up and coming that could have a high growth potential. Another stock is Tesla. So you see how Tesla's performed over the past 5 years. Let's see, it's not giving us a 5-year data, nothing. But similar to Nvidia, you see a 541% growth over 5 years, right? So again, being positioned in the right industry with high growth stocks, so that's where you can get more than the standard 8% from investing in the TSX or in the S&P 500, for example. Taking a look at the Canadian marketplace, you also have Shopify, for example. All right, let's take a look at Shopify. In the last year, they gained 45%. And over the last 5 years, 170%. And we see a dip here around post-pandemic, and then they're recovering. And then lastly, let's take a look at examples in the Philippine marketplace here, Philippine Stock Exchange. We have Converge ICT. It's a fast rising fiber internet provider. tapping into digital expansions. So this is the chart for Converge, and let's pull up their 3-year chart. Looks like they're all back on the rise again. And maybe let's take a look at their all-time. Okay, so this is when they peaked, selling at $36, 39 pesos per share, and then going down to 8 pesos for post-pandemic 2024, and then recovering. So these are some stocks that you might want to consider checking out as part of your high growth stock portfolio. But while you're considering these options, it's important to take note that high growth stocks are volatile, right? So as we've seen in the charts, the high growth stocks they tend to move higher, lower, and they fluctuate over time. So a good strategy to implement when considering these high growth stocks is the concept called daily cost averaging, or DCA. And when you're DCAing, what that means is on a scheduled time, you're purchasing a specific amount, right? So that could be every week, every month, every other week, every other month, depending on when you have the funds allocated for purchasing. You would just schedule automatic purchases of these stocks, for example. That way, you mitigate your risk of buying high and then just keeping on buying high. You don't try to time the market, you're just buying consistently. So daily cost averaging, try that out when you're considering high growth stocks. Now, action items for when you're considering high growth stocks. You want to look at which ones you want to choose and then start researching them, right? So like what we have here on Google, on Yahoo Finance, or on MarketWatch, you have information pertaining to the company. You can also read the news, right? You can also read the updates that's going on that's affecting the stock prices, and you can make a more educated decision on which high growth stock you should include in your portfolio. So you can also use an app like Interactive Brokers, Wealthsimple, or Moomoo, depending on where you are, to keep up to date on the stock picks. You can add it to your favorites and then keep track of the updates that goes on with these high growth stocks. All right, so second strategy is real estate leverage. The key concept here is using other people's money to buy or generate cash that would then produce income for you. And this is also done in a few ways. In a global market, for example, you're able to invest in places like Dubai, Singapore, and the US and leverage low interest loans that these countries provide in order for you to buy a property, fix a property, and flip a property. In a Canadian setting, you have pre-constructed condominiums that are coming up in up-and-coming places. Vancouver, Toronto, there's always up-and-coming real estate developments that investors can buy into and then almost like hold a little bit, sit on a little bit, appreciate, and then have it rented out or have it sold. Now, unfortunately, in Canada, this has become a big problem that, there's a lot of housing units that are now unavailable to the local population because too many investors have taken advantage of this strategy in Canada, right? So there's a bit of a crisis right now, and the government is trying to catch up in being able to, bring back the homes to the Canadians and then have the buildings be built faster. In other places, it might still be a viable strategy. However, in Canada, it might not be the best strategy for now. In the Philippines, we've also seen a lot of these condominiums that are being built in BGC, in Metro Manila, like other populated areas, Baguio City, for example, and you have an influx of foreign investors that are buying into these real estate properties. I know that it was more of a big thing happening a few years ago, and then now always check with the state of the market, right? Because I believe at this point that the recording of this video, there might be an oversupply, there might be issues with foreigners or investors not being able to liquidate or sell or rent out their properties because of the supply and the demand, right? Which is leading a lot of other investors to take a look at other locations, maybe in the Philippines too, or even other countries around Asia that are also up and coming. So always do your research and consider the supply, the demand before, obviously making investment decisions. Now, one way where you can still invest in real estate while not having to use other people's money or the interest from different grants is looking into REITs. Right? So what's a REIT? So REIT is a real estate investment trust. A REIT is an easy way for you to invest or co-invest into the real estate industry without having to shell out a huge amount of money, a huge sum of money. With a REIT, you're investing in, let's say, a specific type of real estate development. In Canada, you have different types of REITs for commercial real estate, residential real estate, nursing homes or retirement home real estate. And then in the Philippines, you also have options for different REITs, right? So let's take a look at an example here. So you see, it has the details of the REIT. Real estate and construction, $7.27 billion, 43.43 sales growth. And then you have the directors. You can take a look at the charts, their financials, and you can deep dive in and research this REIT. So here let's open up ChatGPT about this REIT. Let's see. It's the first and largest real estate investment trust in the Philippines, established to own and invest in income-generating commercial properties, such as office buildings, retail spaces, and hotels. The company incorporated in September 4, 2006, originally as One De La Rosa Property Development Incorporated, and later rebranded to A-REIT Incorporated in 2009. There we go. So with a bit more research, you can understand what they're investing in, their financial performance, and then you can make a more educated decision on deciding if you want to invest in that REIT, right? So that's the last option here in investing in real estate, either with other people's money, with low interest grants and loans, or you could also take a look at REITs, where you can invest a portion of your investment into real estate groups, real estate trusts. All right, so action items here is, if you have low capital, check out the option to go into a REIT or some crowdfunding projects. But if you have a little bit more savings, a little bit more credit history and credit rating, then you can take a look at the house hacking or property hacking investment strategy, where you can leverage your credit rating, your credit scores to get a low interest loan to then improve and invest in a real estate property. All right, so number 3, the third strategy is cash flowing businesses. There's one way where you build a business from the ground up, and there's also another method of getting involved or purchasing an existing cash flowing business, right? In a global setting, you have marketplaces like Flippa or Acquire.com, where you can go in and find a business, for example, that you can come in, buy, improve, and then sell, right? So in this platform, for example, look for a Shopify store, for example. Here, you can find a list of stores with their details, their asking price, and depending on your budget and your expertise, what you want to do here is find a business that, number one, you have industry knowledge of, and then you want to come in and be able to improve that business, to improve the cash flow, or connect it to your network, to your additional tools and expertise for you to increase the valuation of that business. And then third thing you do is then you can sell the business at a higher valuation, or you could then have it generate passive income for you while you rinse and repeat the process. So cash flowing businesses, going back to Flippa, you can find websites here and then find different businesses that are already profitable, and then again you would shortlist the ones that you can improve the valuation, and then you could either sell those businesses or start stacking them up as your portfolio for your own passive income. Now, in a Canadian setting, you also have opportunities to buy into up-and-coming franchise brands that are proven to be a hit, right? So in Canada, for example, you have a chain of coffee shops called Tim Hortons that I know every Canadian knows. I remember when I first arrived in Canada, my auntie on the first week, she said she would want to take us out for a treat, and then that was to go out and try a Tim Hortons drink, right? So it's such a brand that has strong recognition, right? And then it also has opportunity for more expansion. And then the more I got involved and the more I saw the operations for Tim Hortons, for example, I see how efficient they are, I see how effective they are, I see how it's pretty much, the Dunkin' Donuts of Canada, right? Everybody gets their coffee at Tim Hortons. There's still a crowd who, hate Tim Hortons, but without coffee, trust me, they're gonna drink Tim Hortons. So there's opportunities like this in different regions or different countries where you can identify up and coming growing brands that are proven to be profitable and then proven to have done their homework in actually building the brand. Consider looking into some franchise opportunities too that might fill in the gap, the need in the market, and then you can position yourself with that growing wave. Now, the difference between the franchise industry, for example, in Canada and in the Philippines is that in the Philippines, you have a lot more of these mom and pop shop side stall franchise brands, right? So it's lower entry cost, it's quicker to get set up, it's lower employees to manage and maintain. But the thing about them is they can also be very profitable. The same thing, identifying the gaps in the market. Where can these little franchise opportunities, for example, or business ideas, where can they succeed? Because the challenge, for example, in the Philippines is standardizing the quality of your ingredients, the training, the way that you would roll out the actual operations of your business. So by associating or looking at franchise model that's already working, you might have a higher chance of succeeding, starting to build a business, and you want to reduce the amount of time you need to get started. Now, another big wave that's happening too is you have your Lazada stores, right, in the Philippines. So similar to what's happening with Amazon right now in the United States, you have individual sellers that source products themselves and then set up a store within the platform and then start selling products as their own brand. And we're seeing the same thing happen in the Philippines with Lazada, with the platform, where you have sellers who are, getting products, branding it themselves, and selling it as their own privately branded products. Now, that's another quick way for you to start a business that can already be a cash flow positive, right? Because how you do this is you take a look at what's already selling in Amazon or in Lazada. You then go out and find reliable suppliers for that. And then what you want to do is take a look at the comments, right, or suggestions from the other sellers and see what they want to improve, or if they want a different color or variation. That's what you then communicate with your supplier to do those improvements. And then once you improve the product a little bit, you put your own logo, your own branding, then you could import those and start selling them as your own. Check it out, try it out, see do your research and take a look at that opportunity. All right, the fourth strategy is dividend investing. Now, what's the difference between regular investing and dividend investing? So normally when you buy stocks, you're betting on the stock value for it to go up. With dividend investing, you actually can purchase a different type of stock that pays you money back. Now, if you go back to our research tools here, And then we ask here, what is a good dividend stock? J&J. Okay. J&J. Johnson & Johnson. Dividend yield 3%, right? So Johnson & Johnson, for example, has a history of paying and growing dividends over 50 years. Safe, stable choice with dividend business segments in healthcare. Coca-Cola, dividends 3%. So for example here, if you would invest $1,000 in Johnson & Johnson, you would get $30 dividends. $30 dividends, $25 dividends, $50 dividends. So the idea of dividend investing is that you not only bet on the value of the stock going up, but you're actually also paid on a specific time frame, right? So some of these stocks, they pay out quarterly, monthly, yearly, depending on what the dividend payout schedule is. But the idea is collecting dividend payments while also betting on the stock price for it to go up. So in Canada, you have the Royal Bank of Canada, and then you also have different groups of stocks that are now in what you call an ETF, where they have a group of stocks that are put together to then pay out on that schedule, right? You have ETFs like VDY, XEI. So VDY, this is actually part of our portfolio. We're holding VDY. High dividend yield. But always do your research. It's good to have a diversification of assets, and once you consider dividend investing, you can take a look and pick and choose which ones you want to invest in. So in the Philippines, you also have Meralco, and then you have A-REITs that also pay dividends. Now for your action items here, what you want to do is you can set up what's called the automatic dividend reinvestment, or a DRIP. So what this is every month, for example, if you get paid a dividend from the stocks that you're holding, you can have it automatically purchased again, right? So what this is doing is it's compounding, because now you're getting paid your dividends and the dividends are bought back into the company. So you're not just again growing that stock value, but you're purchasing more stocks. Right? So platforms like Questrade have this feature. I believe other robo-advisors, they have this feature. But check into the automatic dividend reinvestment feature in your investment platform, to automate your dividend reinvesting. If you're a beginner, you can also just start off by buying a dividend stock and then just holding it long term. You can have your dividends paid out into the same account, a different account, but just holding it long term, you can slowly see the accumulation of the dividends, and then you can also start to see the appreciation of the stock value. All right, last one. So the fifth one is alternative assets. Now, some people might agree, some people might disagree, but this goes down to your tolerance level, right? Because for somebody like me, I feel like I'm a bit younger, I have a bit higher risk tolerance. So I like to dabble into a few of these alternative assets, right? So personally, I have about 5-10% of my portfolio in these alternative assets, and I'm talking about more high risk assets, right? So you have Bitcoin, you have Ethereum, you have gold ETFs, you have Bitcoin ETFs, and then you also have some agricultural investing. So personally, for me, I hold a few Bitcoin, not a few Bitcoin, but a few portions of a Bitcoin. Used to have a few Bitcoin, but portions of a Bitcoin, a few Ethereum, and then also a few of the top 10 altcoins that are based on market cap. If you're not as willing to be holding cryptocurrencies or Bitcoin directly, an alternative way for you to get exposure to cryptocurrency is through Bitcoin ETFs. So Bitcoin ETFs, they have specific ways of purchasing Bitcoin and holding Bitcoin and making sure that, let's say, your losses are mitigated. So it doesn't dip below 20%, but also it won't, go over 20%. So you have different Bitcoin ETFs or cryptocurrency ETFs that give you these additional safeguards and guidelines in order for you to have a little bit more protection for your money. Or if you don't want to hold the coin directly, again, parking your cash or buying into these ETFs that purchase Bitcoin, like the MicroStrategy ETF or other ETFs, then you'll have exposure to cryptocurrency, without having to figure out all the technical stuff. Now, you also have options to buying these coins in platforms like Wealthsimple or Moomoo if you're Canadian, or if you're in the US, or if you're in the Philippines, you can also take a look at different exchanges. Binance or coins.ph should allow you to buy cryptocurrencies. And the last thing is agricultural investing. Now, personally, this is just something that I wanted to personally invest in because I have a personal background in the farming industry. And what we've done is we've done some research on some up and coming or long-term farming investments. So we took a small position with a walnut farm out in Eastern Europe. That investment should be a 45-year-long investment. Pretty much we purchase rights to trees, right? And then these trees, once they bear fruit, they'll start selling the produce, and then we start getting compensated for the profits, right? So maybe we'll break down that video in another video to show you guys how that all happened, and then the expectation is for those trees, that alternative investment, and then we can break that down. Okay, so that's it pretty much. If you are more risk averse and you are willing to spend a little bit more time into looking into investment strategies that might bring you more than the standard 7 to 8% of the market, then there you have it. Those are the 5 strategies for you to start looking into. Again, if you have questions, if you have comments, concerns, drop a comment below, subscribe to the video, and then we will see you on the next one.